all right, do you want to wait until that happens to buy a house? Like, no.
Yeah.
I mean, because the thing is the price of the house today is not going to be the price of the house when rates come down.
Yeah, when rates are down, the price is going to be way higher. So
yeah.
You know.
So then here's the question that I get all the time: is it better to buy a house that is on the higher side, but you get a really good interest rate, like the last 2 years, or buy a house that's on the cheaper side, but it has a higher interest rate? What's and for me, it's like, well, you can always refinance, right? Yeah. So getting a high interest rate isn't like, it isn't like the nail in the coffin for you. You can always refinance. But what you can't do is if you bought a house that was overpriced, you can't go back and rebuy it at a cheaper price. That's the price. You're with that forever. So that's kind of what I tell my people is like, that's kind of what you want to look for.
I hate this expression that I'm about to say.
Okay.
I hate this. I don't like the expression because it just.
I know what you're going to say.
Let me hear it.
You can marry the house and date the rate.
Yeah.
Is that right?
I don't like the expression. But it's
it.
But to help people understand it, so like as soon as you buy the house, you're locked into the price that you paid. So in the future, when you sell it, it's going to be relative to the price that you paid for it. Okay. The interest rate can change at any time. There's nothing stopping you from refinancing at any time. So, somebody says, all right, well, if I wait next year, I could save $150 a month if the rate goes down to this. And I was like, okay. So do you know what basically $150 a month if you boiled it down to loan amount? So essentially kind of every $10,000 right now in a loan amount is adding about $70 to your monthly payment. It's not exactly that, but that's just kind of a baseline when you factor in property taxes, all the other things that go into the payment. So all right, so then 150, let's say we're at $20,000. So essentially if you're saving $150,000 because the rate is lower, I'm sorry, $150 a month because the rate is lower, but that at that time the house is more than $20,000 higher than what it is right now, then actually you're coming out worse. So when you really look at it from a dollars and cents perspective like that, then you could it puts it a little bit into perspective to that argument, but it's not. That's also not for everybody.
So marry the house, date the rate,
right? Well, but I think you should also also want to be comfortable with who you're dating. Like like you're not just. So I tell everybody this, and I was like, look, here's the thing: is that this is not going to be your payment forever. You do have the opportunity to refinance later. We do know what the cost of the house is right now, though, what you could get the house. This is not going to be your payment forever. However, this is your payment for without an end date. We don't know when this is not going to be your payment. So be comfortable with what this number is and just know that we can improve your financing terms at any time.